Hello, and welcome to today's webinar on improving your TCFD-aligned strategy disclosures. Today's webinar forms part of a larger TCFD implementation webinar series, which takes a deep dive into each of the four core TCFD elements. Today we'll be looking at effective strategy disclosure, what this looks like, and also offering tips and tricks to help you on your journey. This recording features insight from Unilever and Royal Bank of Canada. I'd like to note that these sessions were recorded separately and not as one unified webinar. However, we have amalgamated these into one presentation into this recording for your convenience. The webinar series comes at a time when climate risk is high on agendas worldwide, and climate-related financial disclosure is increasingly gaining prominence. Already this year, we have seen the results of the WEF Global Risk Report, and for the first time ever, the top 5 risks in terms of likelihood were all environmental. And just last week, Larry Fink stated that in the absence of robust disclosures, investors, including BlackRock, will increasingly conclude that companies are not adequately managing risk. So with that in mind, I'm thrilled to introduce you to our speakers. Emma Rogers is Senior Manager with the Sustainability Group at Royal Bank of Canada. Roger Seabrook is the VP of Finance, Marketing and Sustainability at Unilever. And also Gemma Clements, who is the project manager here at CDSB and leads on our TCFD implementation work. As mentioned, these webinars did take place during different sessions, and we have amalgamated them into one just for your convenience today. And I'm Leslie McKenna, the communications manager here at CDSB, and I will be your moderator for today. And now I will pass you over to Gemma, who will speak about our work here at CDSB and explore the current state of TCFD-aligned disclosure.
Thank you, Leslie, and thank you everyone for joining this webinar today. For those of you who don't know very much about CDSB, or for those of you who need a bit of a refresher, the CDSB, the Climate Disclosure Standards Board, is a consortium of 9 environmental and business NGOs. And on the screen there you can see the 9 members of our board, including CDP, SASB, and the World Economic Forum. We were set up in Davos in 2007 with a mission to create the enabling conditions for material climate change and natural capital information to be integrated into the mainstream report. As well as our board, we are also supported by our technical working group, which is made up of over 40 experts across the field from different organizations. And on the screen, you can see a selection of those organizations. Next slide, please. So CDSB's work centers around the CDSB framework for reporting environment and climate change information. This framework was designed in accordance with accounting standards and includes 7 principles and 12 requirements. The 7 guiding principles are the how, so how you should be reporting this information. The 12 reporting requirements tell you what it is that you need to be putting into your annual reports. And we are fully aligned with the TCFD recommendations and principles. The TCFD was developed based on the CDSB framework and other leading reporting frameworks. And we are complementary to those other reporting frameworks, including CDP, GRI, and SASB. We are also referenced in a number of stock exchanges globally. And for those of you in the EU, we're also referenced in the EU Non-Financial Reporting Directive guidelines. Next slide, please. So I'm going to assume that loads of people on the call today have at least heard of the TCFD. I haven't seen the results of the poll, but I know that various people have different levels of understanding. So I'm just going to give a quick introduction into the TCFD and who they are. As Leslie mentioned at the beginning of this webinar, climate disclosure has increasingly become more important. As we have seen in the news, the impacts of climate change are beginning to be felt. And if we take a look at the future projections, we are currently not in line with the Paris Agreement's 2 degrees warming target. Now, the potential impacts of climate-related issues on financial stability have also meant that the role of capital allocation decisions has become even more apparent, which requires investors to have access to decision-useful climate information. And there are some challenges around this. So there is a lack of disclosure, specifically about the potential impact of climate change on business. And where we have seen disclosure, it has been inconsistent. Disclosures are often placed in reports with very little context, and we're seeing the use of boilerplate language. The lack of consistent information hinders investors and prevents climate-related issues from being considered in asset valuation and allocation processes. So this is where the TCFD came in. Next slide, please. And the TCFD was set up in 2015, and they released their final recommendations in 2017. These recommendations are centered around 4 thematic areas, and you can see those 4 thematic areas on the slide at the moment. They are voluntary recommendations that specifically ask companies to report on their climate-related financial disclosures in the annual report, in the mainstream report. The TCFD recommendations does focus on the financial sector and some specific high-risk non-financial sectors. However, the TCFD recommendations are applicable to all organisations. They also focus in on and define transition risk and physical risk and the impacts that those may have on businesses. And one of the things that some people often miss is that TCFD does also look at the opportunities that climate change may bring in the future. Now, the thing that people seem to be most concerned about, and one of the new elements of the TCFD, is scenario analysis and forward-looking information. And we're going to be talking about scenario analysis a bit later in this webinar. In particular as well, looking at the short, medium and long-term impacts of climate change using both qualitative and quantitative disclosure. Next slide, please. So what are companies doing? What is the current state of play? The TCFD released a status report in June 2019. They conducted some analysis of annual reports using AI technology, and they also conducted a survey to find out how the TCFD recommendations have been adopted. On the screen, you can see 4 of the key themes and findings. In particular, they find that the disclosure of climate change information, of financial information, has increased, it has improved, but it's still not sufficient for investors. More clarity is needed on what the financial impacts on climate-related issues are. That's one of the biggest gaps they found in their study. Of companies using scenario analysis, majority of them do not disclose. We know that companies are doing scenario analysis, but we're still not seeing that being reflected in the disclosure. And also, the mainstream of climate-related issues requires involvement of multiple functions, and without that involvement, it can be quite tricky. Next slide, please. So here is a snapshot of disclosures by industry and region. We've decided just to focus on a few sectors today. And if you look across the elements, and we're focusing on strategy, as that's the topic of today's webinar, the banking industry actually generally does the best and has the highest percentages across the recommended disclosures. And as a whole, we're seeing improved disclosures across A and B from all sectors. However, the percentage of companies disclosing information on their resilience of their strategies, taking into consideration the 2-degree scenario, has remained fairly low. And in fact, this is the lowest disclosed piece of information of all of the recommendations. Now, given the timing of this webinar today, we can assume that most of the attendees are based in either Europe or in the American region. So for that reason, we focused in on these 2 areas on this table. And as you can see, it follows the same kind of pattern. Strategy A and strategy B are fairly well disclosed, whereas the resilience element is still generally missing. For a full breakdown across all the regions, you can take a look at the status report online. Thank you. So let's dig in. Let's focus a little bit more on strategy. And this is, as some people say, it's kind of a really core element of the TCFD, because it's all about how you risks you're identifying and how that impacts on the business. Now, even though we are focusing on our strategy today, I do want to make it clear that all of the core elements of the TCFD, so governance, strategy, risk management, and metrics and targets, are interconnected. So you shouldn't be looking at the disclosure in isolation. You should be thinking about all of the recommendations and how those disclosures come together. Next slide, please. So strategy A, which asks companies to describe the climate-related risks and opportunities which they have identified over the short, medium, and long term. So in particular, what we're looking for in terms of the disclosure is a definition of what companies mean by short, medium, and long term. The TCFD don't define those time horizons. They don't do that because they're going to be specific to the context in which your business operates. So if you are a building company, a company that deals in building buildings, your idea of short term will be very different to that of an asset manager. So what we're looking for is organizations to define what they mean and to disclose that in their annual report, and also to provide a justification. So perhaps you're taking into consideration the useful life of your assets, and that's how you define those terms. We're also looking for companies to define what material opportunities and risks have been identified. Now, I'm not going to go into the definition of material right now, because I think we could probably have an entire webinar just on that one word. However, for the sake of kind of understanding what we mean by that, we're talking about information that is significant, that might significantly impact on decision-making abilities. And finally, we're looking at what processes have you used to determine whether these risks will have a financial impact on your organization. Now, as I said before, this is where there's a bit of interlinkage between risk management, because that's also part of the risk management core element. If we move on to strategy B, and this asks companies to describe the impact of climate-related risks and opportunities on organizations' business strategy and financial planning. So in strategy A, you've identified what the risks are, and then in strategy B, you then link that back to your company and talk about what the impact of those risks will be on your company. So, for example, the risk that you've identified might be that there is increased storm damage to some of your operations that are based at the coastline. The impact might then be that there is significant damage to the location, resulting in higher insurance costs, or there is damage to supply lines, which creates delays to getting your products out to the market. So this particular element is where you need to start linking back to the financial disclosure and the financial impact. And in particular, the TCFD have suggested that companies look at these elements, so products and services, supply chain, how you have your adaptation and mitigation activities, and how this impacts on your financial statement, investments in your research and development, and then any other types of impact on how you run your operations. Next slide, please. And finally, and probably the biggest one, is strategy C, which is asking companies to disclose the resilience of their organization's strategy. Now, this one is often referred to as the scenario analysis recommendation, but I want to kind of clarify that what we're actually asking companies to do is to determine how resilient their business is, using the tools such as scenario analysis to make that assessment. So in your disclosure of this information, because I'm not going to go into any information about how you would conduct a scenario analysis, but in your disclosure of that information, you need to think about how have you used climate-related scenarios to inform business strategy and financial planning. You need to tell us about whether you have actually done a scenario analysis or not. Even making that statement is quite crucial, especially at the beginning. I think we often are nervous about disclosing too much information and information that might be sensitive. But I think in this case, at least in the starting, when you're starting out, demonstrating to your investors, demonstrating to the people reading your report that you have considered climate change and you're looking at scenario analysis is important. So tell us that you're doing a scenario analysis, tell us which time horizons are being considered, and then tell us about your assumptions. So that may be in relation to the different policies that may arise, any sort of macroeconomic trends, energy pathways, technological changes. So what are the assumptions that you're using as the basis for your analysis? Those are the key elements. And if you're not comfortable with disclosing the results at the first stage, that's okay, because we understand that it's an iterative process. You're going to be developing and understanding and evolving these scenarios and your understanding of climate change as we develop further. Next slide, please. So rounding this kind of section up, we should be thinking about what is it that investors want to know, because at the end of the day, this is where the information is going. These are the users of the information. So what is useful to an investor? Now, what you see on the slide at the moment are some of the key takeaways on what constitutes decision useful information from an investor survey on TCFD disclosures conducted by one of our board members, SASB, the Sustainable Accounting Standards Board. And we've again focused in on the results that relate to strategy. So investors have asked for companies to specify which time horizons they've used and justify those, as I mentioned before, to provide stronger and more clearer connections to what the financial impacts are going to be, and to have more clarity on the materiality assessment. So how did you determine whether the risk is material or not? I think in the first stages, in the minimum, that's what companies should be looking at and should be focusing on. So on that note, I'm going to pass back to Leslie.
Thank you very much, Gemma. And now I'm pleased to introduce Emma, who will talk us through her perspective from Royal Bank of Canada. Over to you, Emma.
Thank you, Leslie. So thank you for the opportunity to be here. We actually don't do a lot of talking on this topic, so it was nice to have an opportunity to step back and think about the last 3 years and what we've learned, and to really take this opportunity to pass on some practical advice. As Leslie mentioned, I sit within the enterprise sustainability team, so we work on a global basis with all lines of business and functions. As many of you know, and I think there are probably lots of folks from sustainability teams on this webinar, that the sustainability team is often one of the key teams involved in reporting on climate. We're probably the pioneers in many ways on this topic. But if I do leave you with one message today, it would be that you should be working with other teams on this. We work closely with risk management, external reporting, law group, corporate secretary, business segment leads, and the enterprise strategy team to produce our disclosure and just to work on climate more broadly. In my role, I'm providing typically the environmental sort of expertise, subject matter expertise, and then I'm also doing a lot of coordinating of broader efforts and identifying areas or gaps where we can improve. So in our limited time together today, I'm going to focus in on what I think might be most helpful for those that are trying to advance TCFD reporting in your own organization or with your clients. I'll talk about why there's support for the work on climate within our organization, which has helped us to advance our disclosure on the topic. Our enterprise climate strategy, which ultimately is our strategy for better managing climate-related risks and opportunities. And then I'll also cover where we are in our TCFD reporting, realizing that this webinar is about the strategy portion, so focusing in on that piece. And then finally, tips and tricks based on our experience. So hopefully I can capture that in about 15 minutes. For those that have never heard of RBC, I just thought it would be helpful to provide you with a bit of context. Really, we are over 150 years old. We're the largest bank in Canada and one of the 15 largest banks globally by market capitalization. And we operate in 36 countries, but our largest customer base is in Canada. And we take pride in being a purpose-driven, principles-led organization. So definitely helping clients thrive and communities prosper is at the core of a lot of what we do, particularly within corporate citizenship and the sustainability team. So if I give you a bit more context in terms of where we were in our journey on climate in the summer of 2017, when the recommendations, the TCFD recommendations were released, we had a very strong foundation. So if you can move to the next slide, I have a bit of an overview of some of our key milestones on climate. And what you'll see is that we had been reporting, like many corporations, through CDP for over a decade. So that's really reporting out on our direct impact in terms of scope 1 and 2 greenhouse gas emissions, and then partially on our scope 3, which would be travel emissions. And then also, of course, on our governance on this topic and our plans to support mitigation efforts through products and services. So we had a pretty strong foundation. But that being said, I would say that 2017 was a pretty big year for us on climate. In 2017, we published our climate change position statement, which was supported by a group executive and our board of directors, and outlines not only our position on climate change, but also our explicit support for the TCFD recommendations and a commitment to continually produce annual disclosures in this regard. So that gave us a very strong foundation and really formalized our support for the work in this area. It was also acting as our first disclosure. So we produced what would be considered, based on existing disclosure, a disclosure in line with the format of the TCFD recommendations, which got people comfortable internally with what we already had been doing, and then where we were facing some gaps. And then in 2017 and onward, we also identified climate change as an emerging risk to the organization. So this is a formal designation through group risk management, and it's disclosed in our annual report. So it's one that could materially impact our financial results or strategy, but is distinguished by a lack of clarity with respect to probabilities, impacts, timing, and or ranges of potential outcomes. So I think that clarifies sort of the view on climate very, very clearly and is disclosed in our annual report. So 2017 was a big year. So if we go back to 2017 and thinking about why we responded, and the decision that had to be made by senior leaders on this topic in terms of support for the TCFD recommendations and our work in this area, I think it really was this shift that the TCFD recommendations actually signaled, which was this shift from what is your contribution to climate change and how are you mitigating climate change, to how will climate impact your business, your clients, what are the risks and opportunities, and how are you managing these? And this really helped to build the business case internally for a lot of this work that we're doing. So if you move to the next slide, I just wanted to dive into the business case a little bit more, because I think for those organizations that aren't currently disclosing, there's just such a strong case to disclose against the TCFD recommendations, and I think it will also help progress your work internally on this topic more broadly. So there were two factors that really allowed us to move forward, and that's really comes down to your classic materiality assessment in terms of stakeholder interest being at the highest it's ever been, and even higher than it was in 2017 now today, with the mention of Leslie's introduction in terms of the CEO letter from Larry Fink just this past week, and then the regulators, client interest, as well as competitors continually raising the bar on this topic. And then in addition, I would say there's a real need to understand the business and economic impact. So if we move on to the next slide, understanding the potential pathways and what that might mean for your business is incredibly important and has financial implications no matter what pathway or what road we go down. And ultimately, there's certainly very strong indications that there is a better pathway and one that is more economically beneficial and overall financially beneficial. But I think it's very important to ground this also in the reality that we really do need to understand what these scenarios mean for our business, both in terms of the physical risks, where you would see more physical risk due to extreme weather and changing climate patterns if we had a business as usual or a status quo situation. And then if we see more action and more aggressive decarbonization, to meet the expectations of the Paris Agreement, then there will be a different set of implications. And both of these have financial risks and opportunities associated with them. So that helped us lay a very strong foundation for the support on this work. So if we can move forward, I wanted to touch on our climate strategy, which, as I mentioned, really came together in 2018. And we've been making a lot of progress on it internally, and then we published it in 2019. So as we step back over the last 4 years, what we've seen within the organization is that the topic was moving outside of the confines of the sustainability team, even beyond the environmental and social risk teams, and the green finance and investment teams. And this was a broader discussion that was happening at the CFO, CRO, CEO level, and our board of directors. So there was a real need to build a strong framework around this and coordinate our efforts across the bank. So this strategy really does a great job of building a framework on how we're going to better manage climate-related risks and opportunities with these 5 pillars that really bring to bear our strengths as a financial institution. So providing products, services, and advice to our clients to help them in the low-carbon transition, advancing our capabilities in climate risk management, and we called to attention both the need for scenario analysis, applying geospatial intelligence, particularly relevant for the physical risks of climate change, as well as publishing annual TCFD-aligned disclosures. We also made a commitment for our direct impact, the impact of our operations to achieve net zero carbon emissions annually, and then speaking up for climate solutions through our thought leadership and our role as a convener across different sectors of the economy. We often take the role of working with partners, whether they're groups or individual sort of roundtables, to inform public policy on this topic, and then investing in technology through largely charitable partners and universities to address this challenge head on through some of our philanthropy work. So that's at a high level our climate strategy, and I'll touch on a few of those pieces when I talk about climate risks and opportunities. So if we can move forward. In terms of where we disclose, because this is often a key conversation topic when we think about TCFD, we disclose in a number of different places at this time. We have content in our annual report, and we've published content that's referencing the TCFD sort of framework and recommendations in our annual report since 2018. We also provide supplemental content in our ESG performance report, and going forward in 2019, we are producing a separate TCFD standalone report. We also have the disclosure that's through the CDP survey and questionnaire, and then we have the foundations that are provided by our climate change position statement and our enterprise climate strategy. So it's really a suite of external reporting on this topic, obviously with different purposes, in some cases, somewhat different audiences. Moving forward. So I did want to touch on the key areas for us in terms of what we disclose in relation to the recommendations on strategy. We provide a description of climate-related opportunities, and they're really in 2 key areas: products, services, and markets, and then efficient and resilient operations. In the case of efficient and resilient operations, this is, definitely foundational work that we've been doing for over a decade in terms of working very closely with corporate real estate on our programs to reduce energy and emissions, and then in addition, purchasing renewable energy credits and high-quality carbon offsets for the remainder of our emissions. The progress that we make is also reported out in using key metrics in terms of the electricity that we source from renewable and non-emitting sources, as well as absolute greenhouse gas emissions reductions. The climate-related opportunity space with respect to products is relatively new, I would say. It's surprising, but it's actually quite challenging to report out on in a quantitative fashion our contribution to sustainable financing. But we did make a commitment in 2019, and our CEO made this statement and commitment at our annual address to shareholders in the spring, around $100 billion in sustainable financing. And this is, I should preface this with, it's actually becoming more and more common practice within and across the banking sector. So certainly is not revolutionary in that sense. But for us, I think it was a really interesting learning in terms of just the work that's required to be able to get at this number, and then also the benefits of that in terms of building awareness across our partners in the business segments as to what this might look like and who their clients are that fit the criteria, as well as our ability then to look at that number and grow over time. So that's a bit about climate-related opportunities. And in terms of climate-related risks, we have sort of three major buckets of, areas where we may face risk that we disclose on. That's really emerging legal and regulatory requirements, disruptions to our operations, and through the products and services we provide. And we talk about, within our annual report, the actions that we take to mitigate those specific areas of risk. And then we've also, in our ESG performance report last year, and I should clarify that our ESG reporting comes out at a later date than our annual report. So for us, 2019, our ESG report and our TCFD reporting will be coming out in the spring, in March. So we don't have our 2019 report available for this webinar. But we have essentially reported out on the sectors that we're exposed to through credit, through our credit risk, through our lending, and then essentially map that to sectors that are sensitive to climate risk, which is both the physical risk and the transition risks of climate change. So that's essentially an overview of a tool that we use internally to better understand the risks that may be faced by clients in these sectors. And I think an important piece that is really key to remember, and part of the conversation that we have internally is, and have some language around in our reporting, is that with a sector, just because it's sensitive to these forms of climate risk, it does not necessarily mean that, in fact, as an individual client basis, at an individual client level, they will be exposed to these risks. There's so many factors that go into that, whether it be geography, product mix, assets, strategies to mitigate, insurance. There's a very long list. But it identifies the areas where we would want to better understand what these clients are doing in regard to these risks. Moving forward. And then finally, scenario analysis. And this is one where I know I'm sure that we will get a number of questions. And what I'll preface this with is, this is, by far the challenging aspect of the recommendations, and particularly challenging for a financial institution. Stress testing and scenario analysis are used across the bank for things like capital management, strategic planning, and operational risk management. So that's not what's necessarily new. But the use of climate change scenarios to assess loan and investment portfolios is a relatively recent application. And then the use of climate change scenarios just more broadly for financial impact purposes, whereas climate change scenarios were traditionally created for use by government for policy purposes at sort of the macroeconomic level. So those are some of the challenges. I'd be happy to get into more of those. But this was the reason why we were very quick to sign up for the United Nations UNEP-FI, United Nations Environment Program Finance Initiative-led project, along with 15 other banks. We were, at the time, one of 2 banks that participated, 2 Canadian banks, I should say. And then we worked to develop and publish those methodologies with our peers. And I'd say that's also a key recommendation that I will reflect on in a later slide in terms of tips and tricks. But the work that needs to be done with our peers on this topic is quite significant, given the challenges ahead for applying scenario analysis in a useful way, where we can actually get useful strategic insights. And so there are a lot of knowledge and data gaps that we need to close with our peers and with partners, with those that really understand the science, that really understand the sectors. And so there's a lot of work to be done, and that is being done on this. And so I'll leave it at that.
And now we will hear from Roger, who will present from Unilever's perspective.
Yes, hello everyone. Good morning or good afternoon, depending on where you are. Thank you for inviting me to the call. I'll now share a little bit of a perspective from Unilever, although we're very much in the early stages of this journey too, so please don't think that I'm thinking that we know how to do this, but we'll at least share what we've been doing, and hopefully that will be interesting to you. So look, on the next slide, you'll see some of the reasons as to why Unilever got involved with the Task Force for Climate Disclosures. We have for some time been working on sustainable living. Since 2010, we had the Sustainable Living Plan with its time-bound targets that we'd set for our business. And since the early days of the Sustainable Living Plan, we had also been trying to engage with investors and working out how best to talk to them about how sustainability issues were affecting our business and would affect our business in the future. So I could go back to sort of 2011 and 2012, where we had meetings with investors trying to really understand how they were looking at this issue and how we could communicate more effectively with them. I've had many conversations in the last few years, sort of talking about how hard it had been, and of course in recent years that has suddenly changed. So the level of discussion, the level of engagement has dramatically changed in the last couple of years, and that has meant that with the greater interest, we now really do need to make progress on the journey to have a level playing field of disclosure. So that the financial markets and the participants can actually start to price climate risk, and that of course was why the Task Force for Climate Disclosure was set up, and our CFO was actually a vice chair on the group, which meant that we had an additional incentive to try and make sure that Unilever was doing well in terms of our disclosures. So on the next chart, we just have a little kind of overview in terms of how we got started. And it really was, and is in many ways, very straightforward, very basic. We started with what we already had. And if we went to our annual report and accounts, and we looked in the business strategy section and the governance section, the sustainability reporting, and indeed the remuneration section, and you could find elements of the task force disclosures in those areas already. So what we did was we started with what we had. We highlighted where we had disclosures already, but we also looked at places where we could improve and where there were gaps versus the TCFD framework. And unsurprisingly, there were some quite big gaps. And one of those biggest areas was indeed in the area of strategy and scenario analysis, just as Gemma has been describing. And hence, we decided to spend a bit of time and see how we could improve our understanding and assessment and disclosure on strategy and scenario analysis. And on the next chart, this just goes back to the information that Gemma shared a minute or two ago. You can see here that it absolutely comes down to those three areas, A, B, and C, in terms of describing the climate risks and opportunities, and then seeing what the impact on the business would be, and then look at the resilience of the business to that strategy, to that scenario. So that's what we did. And our first step, which was in 2017, so it's already a couple of years ago, was we decided to do a high-level scenario analysis on the total business. And on the next chart, you'll just see an overview of what we did. So as I said, it was a high-level scenario analysis. It was looking at the totality of Unilever. And I won't take time now to describe our business to you, but suffice to say that it's a complex business, many products in different categories, in different markets. And therefore, we felt that we had to start with a top-down view so that we could really begin to understand, what the main issues were for a business like ours, and whether any of our particular business activities would be, differently affected by climate change. So we took a top-down view. We looked at some simple scenarios. We tried ruthlessly to simplify. We know it's horrendously complicated when you get into the detail, and therefore we felt that to make a start and to get moving, we should simplify. We worked with internal experts and some external experts because we didn't have all of the knowledge in-house as to how to do scenario analysis or how to look at carbon climate models. And wherever possible, we very much used existing information, used other people's tools, other people's scenario work and climate models. So again, we tried not to invent new things. We tried to just work with what other people had done and then try and apply it to our business. And very importantly, I think we looked at two scenarios, which you'll see at the top, the top of the bullet points on the chart. The first was a 2 degree C scenario, and the second was a 4 degree C scenario. And you heard Gemma talk a minute or two ago about time horizons. This was one of the most complicated things for us to, first of all, understand ourselves, and then to start explaining to others. Because what we decided to do is the 2 degrees and 4 degree scenarios are the temperatures the temperature outcome in the year 2100. So that means that in the 2 degree scenario, the temperature would have increased by 2 degrees in 2100, and equally the 4 degree scenario, the temperature would have increased by 4 degrees C in 2100. But what we did then is we looked at the journey to get to that point, and we chose to look at the impacts in 2030. So it's the journey to 2 degrees C by 2100, but looking at the impact on our business in 2030. Now that's already quite complicated, but then you've got to think about, well, what business are you looking at? Because we don't really want to try and forecast, what will Unilever's business be in 2030? Because that's another whole discussion. So what we did is we took Unilever's business footprint as it was at the time we started doing the work, or just before, where we had the full data for the financial results, the P&L and the balance sheet and so on. So I don't really expect everyone to understand this, but just to say that this question about the time horizons requires a little bit of thought, just so you're really clear about what are we looking at. And in our scenario analysis, we were looking at the two scenarios we've said, looking at the impact in 2030 based on our business as it was in 2015, using that footprint of the business. And then, as I said, we used external models. We took whatever we could from other people, and we applied the knowledge from those those climate models and the impact that would have on countries, and we just then applied that to our business and assessed the impact it would have on our operations. And we looked very much at the gross impacts. We didn't assume that we were trying to mitigate them by doing things. We just took a first view saying, what would happen if this was the climate scenario? And if Unilever just took the conditions as they came and, for example, absorbed any cost increases that might come from some of the scenarios. So on the next page, I'll just give you a quick overview of the 2 degree scenario. And again, I'm sure you could challenge this, and I'm sure some people could now improve dramatically on this, but this is where we started from. The 2 degree scenario we felt was very much a scenario in which countries work together to invest in low carbon energy technologies and to tackle climate change by looking to change deforestation, change land use and so on. So it's essentially a scenario in which action is taken. And therefore, the big attributes were high carbon prices, because governments moved to price carbon in a real way, and action to stop deforestation and stop land use change. And that's important to us because, of course, many of our products, some of them food, and indeed some of them not, use products that come from agriculture. Therefore, it's very important to our business. And through those actions, global warming is limited to 2 degrees C, and we very much then in this scenario focused on the impact of those actions taken on our business. And on the next chart, you'll see a sort of little schematic which tries to give a sense of the logic flow. This doesn't capture everything, but just again, trying to keep it as simple as we could. we started with the scenario. We looked at the main attributes that come with that scenario. So as we just said, carbon pricing becomes real. You actually have to pay for carbon. And deforestation, is stopped, and therefore that has an impact on agricultural land use. And then we track that through to the impact on our business. So, for example, carbon price could affect our sales because rising energy prices might suppress demand for some of our, products that require, hot water, for example. Manufacturing would be impacted because the cost of electricity, fuel, and distribution costs go up. Raw materials would be impacted because our suppliers are having to pay more for their fuel, electricity, and the cost of things like fertilizers would increase. So I think you'll get the idea that we start with the scenario, then look at the attribute, and then translate that through to the impact on our business. Trying not to get too much into the detail, realizing that it would get too complicated too quickly, but also trying to do enough work to make it useful. And from that, we then turn that into an impact on the P&L in terms of turnover, cost of sales, and hence of profit. On the next chart, you'll just see a quick similar view of the 4-degree scenario. This is one in which action is not taken and climate change happens to the extent that we end up at a 4-degree scenario by the year 2100. And in this scenario, by the year 2030, we're seeing real impacts on the weather, and therefore we're dealing with increased temperatures and variability in weather affecting economic activity and GDP. We're seeing examples of water stress, greater than we do today, increased severity of drought events, and increased frequency of extreme weather such as storms and floods. So this is very much a physical impact scenario. And now the main risk to Unilever comes from the actual impacts of water stress affecting agricultural prices, affecting GDP growth, and so on. And again, in the next chart, you'll then see the same schema, just showing how that 4-degree scenario has attributes associated with it to do with impact on GDP, drought events, water scarcity, and extreme weather, which then has its impact on our sales, as you can imagine, and taking that through to the profit and loss account view. So pretty high level. I'm not saying for a minute that we were doing really detailed analysis here to assess the impacts on our P&L, but we were getting a sort of first view of how big the impacts could be. And on the next chart, you'll see, what we then did was we sat down with management teams within the business. We went through the findings. We reviewed, what we were learning in terms of the impact on our business. And the high-level summary for us was that the real impact would be happening on our agricultural supply chain in both scenarios, whether it be the carbon pricing and land use being changed as we all adapt to limit temperature rise, or indeed in the scenario where we don't do that. Again, agriculture is the place that our business is most impacted. This is what the analysis showed us. And so what you see on the page, it's not a very pretty chart, but this is simply a screenshot from our annual report and accounts, the strategic report, page 33 from 2018. And this is where we then, wrote up the outcome of that scenario analysis and captured it in our annual report and accounts. So very much, as Gemma said, integrating it into our financial statements. From this, we then said, well, what do we do now? And one of the things we were doing was looking at the status report that the Task Force for Climate-Related Disclosures were issuing, and looking at what other companies were doing. And when you do that, you can see just how many companies are doing elements of this strategic work and scenario analysis, to a very high level. And what we then decided to do to move this forward was to do some deep dives in this agricultural area that we'd highlighted as being important to the business. And on the next chart, you'll see the sort of phase 2, we called it. We did a deep dive into an agricultural material that is important to us, being soy. And in this case, we're now not doing a big overview of the whole of Unilever. We're now really focusing on one commodity. And again, working with both internal and external experts, we looked first of all at what's going to happen to yields as climate changes in the places where soy is grown. And then we established a sort of a model for pricing, which links the demand and supply for soy to the price we would have to pay. And then from that, we looked at the impact on our business of the future yields and price that Unilever would have to deal with as we went through the scenarios. And in this particular scenario, we found that for soybean, actually in some places, the soybean yield may increase over this the time horizon we've chosen, as a result of the particular characteristics of that crop and the particular impacts of climate change on the regions in which it's grown. Again, very limited on this, and I think one of the big things we learned in the whole process is that we need to keep explaining to ourselves and to our colleagues that scenarios are not forecasts of the future. This is not us forecasting what's going to happen, because there are many other things that can intervene to change the outcome. But just based on the modelling we did, we could see what the impact on yields and perhaps our price were going to be based on the scenario we'd chosen, which could then lead us to think about our sourcing strategy and our formulation strategy for our products based on what we were learning. And that soy was chosen partly because there was already good data. It is a big commodity for us, but there was good data to work with, and therefore it was a good place to start. Again, reflecting the fact that we were learning and trying to make progress on this without, choosing something that was so difficult that we would, make very slow progress. And so that's why we chose soy. And then on to the next chart, what we then decided to do, and where we're working at the moment, is continuing this work, looking into two more difficult commodities, tea and palm oil. They're more difficult because the data isn't so good around the impact of yield of climate change, and also because in the tea market there is a much more complex relationship between supply volumes and price, because of the different types of tea and the different formulations and the different tea markets. So, again, learning a lot about how the pricing mechanism works in the individual commodities. And I would say that we're now at the point, probably as we work through these, of beginning to think then where do we go next? Because as you learn, you get better at understanding what scenario analysis is and how to do it, and you also get better at having the conversations with the colleagues, the subject matter experts in procurement or in the R&D teams, or indeed with your senior colleagues, because again, this is often new to them. And I think as we think of our next steps, we will be kind of building on what we've done, but also then trying to learn from what the feedback we're getting from investors and users of the disclosures. And Gemma mentioned a minute or two ago, the disclosures were felt to be insufficient and inconsistent across many companies, and certainly that's what we would feel when we look at it. And I think the starting point for us is we do need more companies to start disclosing that. So we first of all need a bit more sufficiency, if you will, in order to get more information, more companies doing it. And then we can focus a bit more on the consistency to make it easier for the users of the disclosures to actually compare companies. But it's very hard to do that when you don't have companies disclosing. And hence that sort of initial focus on doing more disclosure and looking at what other companies are doing, and then hopefully all of us learning together and getting better at making the right disclosures. So that's where we are now. I think on the next chart, we're just going to have a look at some of tips for implementation. So let me just hand back to Leslie. Did you want to introduce this section, Leslie?
Yes, thanks very much, Roger, and such fascinating insight. We really do appreciate you going into so much depth. I think it's quite a one, and we've had quite a few questions come in as well. So we do encourage everyone to keep submitting their questions. You can use the Q&A function on the right-hand side, and we will go through some of these at the end. Now we do have some tips for implementation. So we found in yesterday's webinar that actually some of the questions were addressed during the tips. So let me pass over to you, Roger, and if you want to talk us through your top 6 tips, and then Gemma will also give some tips from a CDSB perspective. Thank you.
Certainly. So look, I'll go relatively quickly here because I think I've said, all of these things as I was going through. From our learning, the first thing is to start with what you have. I very much hope that most companies will find that they've got something to start from, and that would be our advice. Definitely look at what others are doing, both similar businesses and different businesses. We learned a lot from companies that were very different from us because they had got a lot more experience in scenario analysis. And so, different businesses can often help you make faster progress. Very much start with your current view of material impact. That view may change as you do the work, but you need to start somewhere. And I realise multifunctional teams are expensive and resource intensive, but I do think it is the best way of getting building knowledge and moving forward on this. I'm from the finance function. This would have been a far less useful piece of work if we'd just done it ourselves. The real richness came from working with climate experts and R&D experts and people in our procurement teams. And then take small steps. Don't try and do everything in one go because this is complicated. There's a lot to do. So we've made it clear all along that we're taking steps, and we would recommend doing the same. And of course, most important of all is really get started because it can be a bit daunting. And the thing to do is to choose one area and to make a start and get going. So that would be sort of the things that we've learned over the last few years.
Thank you, Roger. I think that's a really important point as well. It's about getting started and getting something down on paper at least. So Gemma, over to you.
Thank you. And I totally echo everything that Roger said in his presentation and in his top tips as well. And I think from us, in terms of the disclosure element, I think in particular, adopting the correct lens. And by that, what we mean is that for this exercise, we are looking at climate change and climate-related risks as business risks. That's not to say that there are, to consider climate change as a sustainability risk or kind of the impact that the company has on the environment is important. But for this particular exercise, and the reason TCFD is different, is because it's specifically considering what is the financial impact that climate change could potentially have on the business, and to kind of maintain that lens as you're doing the analysis and also disclosing this information. Linking financial and non-financial information is incredibly important. I think I said it during my slides, and Roger's, really specifically kind of highlighted that, it does always kind of go back to what are the financial implications. And I strongly recommend that companies utilize existing standards and metrics. A lot of companies who are already disclosing to CDP, for example, you will already be collecting some of this information and disclosing it to CDP. So just kind of utilizing that and don't burden yourself with trying to find new information if you've already collected it and using it in a different way. This point kind of follows on from Roger's really well, is make as many of the 11 recommended disclosures as you can, but understand that, we also understand that it is a process, it is a journey, and, just take the first steps, do as much as you can up front and just get disclosing. And finally, put this information in your mainstream reports. Having it in kind of one place and consolidating it in one place makes it really makes it easier for investors and those using the information to be able to find the relevant detail that they specifically need. So yeah, those are our top tips for disclosure.
Thank you very much, Gemma. Over to you, Emma.
So I definitely have a lot of the same tips and tricks, so I won't go bother overlapping. But essentially, with both the first top 2 tips, I'd say they're really in line with, you've got to start somewhere. We've found that the practice of creating a mock disclosure or essentially showing the teams that may be showing some hesitancy or resistance to the notion get a lot more comfortable when you can show them exactly what this would look like or entail, where there might be gaps, where there might be questions. And then I would say as well, we, try to not let perfection be the enemy of the good. And I think, with the scenario analysis piece, that's a perfect example in that we, wanted to disclose some of the challenges and some of the processes that we've undertaken and some of the work that we've done with our peers. But that's obviously not ideally, what the TCFD would imagine us disclosing a few years down the road. So that's another key piece. I think we have to be realistic that this is, with new things, we have to try and test out things and disclose some of the information that is really quite pragmatic and honest about the challenges. Then I would say as well, don't go it alone. There's so many people within the bank that can actually provide so much expertise and a different perspective on this topic, and particularly external reporting law group who are very familiar with this type of external reporting. And then I would say lastly, collaborating with your peers. I can't oversell that enough in terms of particularly the areas where we need comparable and consistent disclosures, and there aren't necessarily clear solutions at this point in time, particularly around scenarios, the methodologies that relate to those, and then the metrics that we should be reporting out on. That's it.
Brilliant. Thank you so much. And now I would like to present some useful resources and guidance to help you implement the TCFD recommendations. Firstly, you can see on the right-hand side the TCFD Knowledge Hub, which is the go-to resource database to give you all of the tools that you need to implement the recommendations. So on the TCFD Knowledge Hub, we've got case studies, white papers, different guides and publications that have been submitted from leading organizations. We also recently launched e-learning courses on the TCFD Knowledge Hub. Currently, there are 3 modules online, and they are freely accessible to all. So we do encourage you to sign up via learn.tcfdhub.org. We also have some useful guides that can help you implement the recommendations, including the TCFD Good Practice Handbook, which you can see on the left-hand side. And this handbook offers examples of annual reports from companies across the G20, so looking at both the financial and the non-financial sector and highlighting what good practice looks like within their annual reports. The Corporate Reporting Dialogue also released their Better Alignment project report at the end of last year, and that maps the 5 leading framework providers and standard setters against the TCFD recommendations. And that brings us to the end of our presentations. I would like to thank you all for participating, and thank you to our speakers. If you do have any questions, please do feel free to reach out to us directly at info@cdsb.net, and we'd be happy to assist you with any inquiries that you have. Wishing everyone a lovely day, and I hope to see you on future webinars. Bye-bye.